Thanks so much for being with us here on India Today. You're watching the Business Today show with me, Chaiti Narula. Let's begin this broadcast with the top stories. Global gains and return in foreign buying aid sentiment as benchmark eke out modest gains. Nifty closing just above those 18,000 levels, while Sensex closing a flattish day of trade above 61,000. RBI grants in principal note to 32 online payment aggregators allowing continued operations. Amazon Pay, Camp and Google, Reliance, Zomato amongst the notable entities with a go-ahead. The central bank returns applications of players like Paytm and Pay. Gautam Adani backed Adani Power's planned 7,000 crore deal to acquire thermal assets of DB Power collapses. The move sets the Adani Power stock in motion to settle with gains of nearly 5%. India's largest mortgage lender, HDFC, raises a whopping 250 billion rupees in the country's largest privately placed corporate bond issue. The company sells 10-year bonds at a coupon of 7.97%. A quick look at how the markets fared today. Let's begin with the benchmarks maintaining stance in the green on the back of a positive global cues and sentiment moving return of the foreign investors. The Sensex clocked in a 44-point gain to settle above the 61,000 level, 61,319 to be precise. Meanwhile, Nifty saw a flattish close. You can see that on your screens, albeit in the close with a marginal 20-point gain. The day belonged to the broader markets, in fact, which spotted a second day of modest gains worth 0.7%. Amongst the gainers, we had ONGC, Tech Mahindra, Apollo Hospitals, Divis Lab and Nestle. Let's bring you the losers. Top Nifty losers on your screens: BPCL, Bajaj Finance, M&M, Eicher Motors, HDFC Life. We saw cuts of nearly 1 to 2% on stocks like BPCL, Bajaj, M&M, Eicher Motors and HDFC Life. Good news for India's taxpayers. The Central Board of Direct Taxes has released tax return forms for the financial year FY23, which is well in advance this year. The move is expected to help taxpayers be well prepared for reporting requirements on their tax returns. Moreover, the forms have also been amended to include additional questions relating to the selection of the new regime, which will enable the Income Tax Department to know whether you opted in or out of the new tax regime in the past. To decode this further, BTTV's Sakshi Batra spoke to Aarti Raute of Deloitte India. Listen.
These forms have been notified earlier than expected. So what will this result in? Will it result in a smooth process of tax filing? Will it result in more time to the taxpayers and, timely fashion that they can file their ITRs?
Yes, of course. I think it is going to be a good thing if the taxpayers who have a substantial amount of income really go through the forms and look at the details. And we will talk about what are the changes in these forms in a moment now. But definitely making sure that things are there in place before the tax filing season starts, or even before the financial year starts, makes it really very nice for the taxpayer that everything is in place. We had a couple of years where there were a lot of glitches on account of the new portal being, coming in place right in June when it was a tax filing season for the salaried taxpayer, and it created a lot of issues. And then the return filing due date kept on extending.
Sure.
So I think this year the government has come, CBDT has come out with the forms quite in advance.
Sure. Are there any major changes to the ITR1 specifically, the Sahaj form, which is the most commonly used by salaried taxpayers out there?
The ITR1 is a form which is specifically filed by individuals who are residents. So if you are a resident but not ordinary resident, or you are a non-resident, you can't really file this ITR form. So also, there are some other conditions like, for example, your income cannot be exceeding 50 lakhs. You should have only one house property, or if you have brought forward losses or income from capital gains, then you will have to use ITR2. So ITR1 is used by only people who have salaried income from other sources, and only one house property. and who are residents in India.
Sure.
And for these people, there has not been too much of change. The only probably a very subtle change which is there is you have your filings that are required in case of search and seizure processes. And at that point of time, the tax authorities can ask the, the persons to file a tax return. And there was not, I mean, the earlier ITR forms did not provide for this kind of a concession. And hence, now it has been enabled here. So that is one change.
Okay.
There is another smaller change saying that there is a criteria to, for people who really mandatorily need to file a tax return. And one of the criteria over there is if you're depositing more than 1 crore in cash in a current account. But this has been taken out, and I guess the reason could be probably that salaried people may not be able to open a current account. So this is not really a criteria which is applicable to them. And if you have business income, then you anyway can't use this form.
Okay. If you could just sum up for all our viewers right there, the top 3 takeaways from these new notified norms and what all investors, viewers in general need to now remember when they approach their ITR filing.
In terms of the new ITR forms, the CBDT has been nice enough to provide you all the details. So please go before filing, look at which form applies to you basis your sources of income, and make sure you're checking out the right forms. There are very few changes from last year which are now going to be applicable, at least for the salary class. The biggest is, of course, for the VDA transfers, the virtual digital asset transfer. So those are the details that you should keep handy. It is always recommended that you make sure that you collate all the details of your income in time, because a lot of times what happens is people start filing their returns, collect a lot of documentation, and halfway through they realize, oh, but they do not have certain TDS details or certain income details are missing. In those cases, they will have to go back to those providers and get those details. So make sure that you have a checklist where you're checking out whether you have the details in place or not before starting off to file the tax return. And one of the things which is really recommended is to make sure, see, we have a paperless return. So you're not really filing any documents with the return as such. But
Correct.
What you need to do is to archive all the basic documents, all the base documents with you to make sure that if in case you have an audit at a later stage, you are able to produce these details in a timely manner without asking for any adjustments. And there is, you're able to substantiate what you have filed in your tax returns.
All right. Yeah. Yeah, please continue.
Just one last thing. The government has provided you or enabled the data for the investments, the sales, the transfers, the assets that you procured in the annual information statement that is provided to you. So please make sure that you're looking at the annual information statement as well as your 26 years, because those are information which are available with the tax department. So any mismatch over there, that's the primary thing which will come. So.
Now with RBI releasing list of applicants that have received an in-principle nod to operate as payment aggregators, names like Google, Reliance are amongst those that can continue operations. But what happens to those applications stand returned? And what does this mean for the consumer and the merchant community? Let's take a detailed look at what this move entails and the road ahead for the fintech players.
The Reserve Bank of India has revealed that it has granted in principle approval to 32 existing online payment aggregators, allowing them to continue their operations. Amazon Pay India, Google India Digital Services, Reliance Payment Solutions and Zomato Payments are among the entities who have been granted in principle approval. The payment aggregator framework, introduced formally in March 2020, mandates that only firms approved by the RBI can acquire and offer payment services to merchants. But who are these payment aggregators and what do they do? A payment aggregator company provides various online payment methods in one application and facilitates different payment transactions online as well as offline, including billing counters, among others. Apps such as Google Pay, Paytm, PhonePe all act as intermediaries that enable consumers to make lightning-fast transactions within seconds, empowering merchants to manage their transactions on a digital print. What makes these apps essential for the digital transaction ecosystem? More often than not, these payment apps offer secure and flexible payment gateways. Not only that, they ensure a safety net against frauds and cyber threats. According to RBI rules, a company that wants to apply for aggregator recognition must have a minimum net worth of Rs 15 crore in their first year of application and at least 25 crores by the second. Not just this, it should adhere to global payment security standards. Indian startups such as PhonePe and DreamPlug Paytech are among the few names that await RBI approval. However, applications of names like Paytm and PayU stand returned. Are you wondering whether you can or cannot use these apps anymore? Well, you can, if you had been using them over the last couple of years. The recent rejections means that the apps can continue to function, but cannot take on board new merchants until they receive regulatory approval. Bureau Report, Business Today Television.
Now another setback coming in for Adani Empire. The company's power unit has given up on its plan to acquire DB Power for 7,017 crore rupees. On the other hand, after weeks of getting hammered by the bears, Adani stocks had their best day in the month today. Adani Power and Adani Wilmar surged 5%, followed by 1 to 2% gains on Adani Enterprises and Adani Ports. Meanwhile, Adani Transmission ended the day in the red. We're with us Anand Adhikari, Managing Editor of Business Today magazine, to help us explain the implications of this particular development. Anand, take it away in terms of what the implications are as far as this particular development is concerned, given the fact that the company's power unit has given up on the plan to acquire DB Power, and that was for a whopping 7,017 crore rupees.
So it's a big setback, and today Adani they runs one of the biggest or the largest power plants in India. They have a capacity of around 12,450 megawatt. So this DB Power was bringing around 1,200 megawatt. So almost 10% of the capacity, additional capacity, was coming through DB Power. Now first, if you see, it was a pure inorganic expansion. So they were getting additional 10% capacity, without going through the greenfield route. I mean, which we all know, takes time with approval and all. Second, if you see, the geographical diversification. This plant is based in Chhattisgarh, and today, Adani Power has plants in Gujarat, Maharashtra, Karnataka, Rajasthan, and Chhattisgarh. And now, with this 1,200 additional capacity, in Chhattisgarh was moving right up to the third, slot. So a big diversification, which Adani Power was planning. So in that sense, in a setback, I'll give you two more reasons. Why it's a big blow to the Adani Group. One, this company had power purchase agreement with the electricity board, so assured sale of power to these electricity companies. And second, even for the fuel, they had a tie-up with Coal India. So all in all, if you see this particular DB Power plant, with this 1,200 megawatt capacity, was bringing a lot of benefits, to the Adani Power. But in a changed circumstances, as we have seen, massive erosion in Adani Group companies, it makes sense for them, maybe to halt that, because they can easily revive this deal later.
All right. All right. Thank you for joining us with the very latest details on this. We leave it at that. Index provider MSCI postponed the implementation of weight changes in Adani Total Gas and Adani Transmission. MSCI says now the following changes will be enforced in the May index revision. Remember, this comes after the index provider cut the weightings of 4 Adani Group companies, including the flagship firm Adani Enterprises, last week. Shifting focus now on India's electronic and mobile phone space. Expect India's mobile phone exports at 75,000 crore rupees in the current fiscal, says Pankaj Mohindru, the chairman of Indian Cellular and Electronics Association. Here's a slice of that conversation he had with my colleague Chetan Bhutani. Take a look.
Tell us about the industry first. How is it going, and when we end the fiscal year, what would the numbers stand at?
In 22-23, we'll end up with about 75,000 crores of exports.
Okay.
And about total production of about 350,000 crores of mobile phones. That's where we are going to land up with. And the total electronic production will be approximately $90 billion. Total electronic exports should cross $20 billion.
The industry, on the other hand, has been seeking a lot of strength with respect to the PLI incentives. Even non-fiscal incentives also the industry seeks. So are you saying that the industry needs to move beyond PLI schemes and fiscal incentives or non-fiscal incentives and start work on their own so that they could probably then become Atmanirbhar?
There is some things which the industry can do. I think that will happen automatically once the scale kicks in. Once the scale kicks in, then you can't hold back Indian entrepreneurs. That is the tipping point where things will dramatically change, and that portion of disability will get taken care of. Before that, I think the governments have to kick in as far as infrastructure is concerned, see how better the power situation now is compared to 2 decades back. Now, we need to do better in terms of pricing.
Last question, how are you seeing India's cellular manufacturing and electronics manufacturing industry going forward? How are the supply chains concerns for India, and are you in touch with the government for any incentives or schemes or any other support that you might be wanting, sir?
This is a very proactive government, and all of government and all of industry works together. The same thing we can say about Government of India and Government of UP. And in fact, in some ways, the government is running ahead of the industry in identifying the gaps of the industry and asking us what we need. I think it's a wonderful partnership, and I'm very optimistic about the future.
Well, that's all that I have for you on this edition of the Business Today show. Thanks so much for tuning in. Thanks for your time. Have a very good night.